Good morning. I'd like to welcome you all to our Preparing for COVID-19 Recovery, Loan Options and Forgiveness Strategies. And yes, this is December 29th, 2020. It's been a long road that we've traveled so far, and I think it's 30 plus webinars that we've done on recovery, COVID-19, and I'm sure there'll be many more to go. Today we're powered by SacsLLP.com. That's the accounting, tax, and advisory firm. Sachs Wealth Advisors, also known as SacsWA.com, and S2 Solutions, our technology arm of the firm, S2Solutions.tech. And of course, we are required to tell you that we are presenting this information for general guidance only, so it doesn't constitute the provision of legal advice, tax advice, accounting services. You know, you got this. So you need to talk to your professional advisor. Hopefully it's us, and we're here to answer all of your questions. Let's talk about CPE. So yes, today we are going to give you a little bit of CPE. We're going to try to go the full 50 minutes, but let me tell you what you need in order to get the CPE. First, understand you got to stay for the entire 50 minutes plus. If you leave, you're not going to get CPE. Second, you need to also stay engaged. Believe it or not, we know when you're not listening. Third, you need to answer 3 out of the 4 polling questions that we will be giving you today. And fourth, if you look at the handout section, you'll see there is a participant evaluation sheet. Fill that out, send it to who it's supposed to go to, and we will give you CPE. Here's our wonderful presenters today, myself, Todd Polinak, and my partners, Josh Shanani, Steve Ehrenberg, and also our new guest, Shivani, who is going to talk to us a lot about taxes. But we also have other members of our recovery task force, Angelo, Melissa, Amanda, Julia, and also Matt, who are working on the back end to help us not only get the loans forgiven, but as you'll find out soon, prepare for the PPP2. Today's agenda, we have an introduction that we're going through right now. We're going to talk about the existing relief options, and then we're going to get into the Consolidated Appropriations Act of 2021, talk about the PPP loan and EIDL updates, the Shuttered Venue Operator Grant Program, other provisions and benefits, tax benefits and tax extenders. Then we're going to wind up talking about the loan forgiveness application timing, and finally some final thoughts on 2020. And yes, I think this is going to be our last webinar of 2020. So let's kick it off with the very first poll question, number 1. So remember to answer this so that you will get your CPE. Sachs LLP recently relocated its New Jersey headquarters to which town? Clifton, Lyndhurst, Parsippany, or Princeton? That's Clifton, Lyndhurst, Parsippany, or Princeton. So at this point in time, I'm going to ask you to send in your answers so I can see where we stand. Okay, is it Clifton, Lyndhurst, Parsippany, or Princeton? 5, 4, 3, 2, 1. Close out that poll. The answer would be Parsippany. Yes, we were in Clifton for many years, but now we have moved to the great city of Parsippany. And when the offices finally do allow visitors, all of you on the webinar are welcome to come. Not all at once, of course. And so I'm going to turn over this next section to my partner, Steve. Steve, talk to us about the existing relief options. Steve, take it away.
Thank you, Todd. Excuse me. Hope everyone is doing well. Had a nice holiday time off if possible. And so as Todd mentioned, I'm going to talk about some of the existing relief options. And kind of the reason I also wanted to discuss this slide is this is as recent as December 23rd, so only about 4 weeks ago. And we see already how much of this has changed. So PPP1, which basically is coming to a conclusion, but now we've seen the issuance of PPP2, the EIDL program, which basically ends at the end of this year, although the grant program, which you'll see here, was crossed out, has been extended. Josh is going to discuss that. We have the employee retention credit, and you see on the eligibility slide, it says cannot accept PPP loan. Well, the new Consolidated Appropriations Act has eliminated that. So now PPP recipients can also take benefit of the employee retention credit. You have the payroll tax deferral, the Main Street lending program, which for all intents and purposes will end at the end of 2020, and a number of other relief programs that are out there as well at the state and local level, grants, rental assistance. There's a lot out there. So we're hoping people have had the opportunity to take advantage of it. But more specifically, as I'm sure you've seen, there's been a lot of news about this. The recent signage of the Consolidated Appropriations Act 2021. So this was a massive bill, 5,593 pages of legislation. Even trying to put that in context in terms of a book that you've read, I was trying to put in context of War and Peace. I tried to read that once and didn't finish, but you know, that War and Peace is 1,400 pages. You could read that 4 times and you'd be at the equivalent here. So just a massive bill with tons of information, and we're certainly not going to go through the entire act on today's webinar, but we are going to try to highlight most of the areas. We're going to discuss the $900 billion in COVID-19 related aid, but this bill also funded the government through September. So there was the opportunity. Well, I shouldn't say opportunity. There was the chance that the government was going to shut down absent this bill and the 2.3 trillion in total omnibus measures. But state and local government aid and liability protection are absent from this bill. These had been 2 sticking points between the Republicans and the Democrats. So we will see in the coming months, next year, if this is addressed as well. So it's something that we'll be keeping our eyes out on. But back to the Consolidated Appropriations Act, we saw that it was passed by both houses of Congress, not unanimously, but there was certainly a lot of bipartisan support for this bill. This act, and we've seen that, but it did take President Trump actually push back on it. And initially we were not aware as to whether or not he was going to sign it. He had mostly demanded an increase in the stimulus payments. They were initially, or in the bill as it is written now, or act, I should say, in the act that is written now, they're $600, but he was pushing for $2,000 per recipient, as well as changes to other foreign aid and some other measures as well. So we'll see, again, we saw an act passed just yesterday by the House, see if it makes it through the Senate to increase those payments to $2,000, but Shivani's going to touch upon that, and I certainly don't want to steal any of her thunder. So the next slide, we're going to specifically discuss some of the benefits related to PPP, PPP1, and the second round of funding for PPP as well. Something that we had been closely monitoring and seeing a lot of back and forth about was the tax treatment. So that this new bill has clarified that expenses paid for with forgiven PPP funds are deductible for tax purposes. So it's a windfall here and something we were hoping was going to happen, and now we have written confirmation that it has. Another benefit, though, is that it's included in tax-exempt income. So LLC owners and S-Corp owners do receive basis for this, so it gives them an additional opportunity to potentially deduct losses. Specifically included in this act was a second round of PPP funding. It's called the second draw, so you'll hear it referred to throughout the slides, and maybe even when you read information in the news or watch it on TV, you'll hear it called the second draw, PPP2, as opposed to PPP1. So just so you're aware that there will be some different terminology, some different nomenclature out there. And this just was released, just came out a couple days ago. So we have to give the SBA some time to enact some regulations, but depending upon the different clauses, they'll have anywhere from 10 days to 24 days. So we should see some information soon related to the rules and regulations. I know a lot of clients have been asking us about, well, when can I apply? When can I apply? Because as we saw, there's only $284.5 billion associated with this program, and we saw last time from PPP1 how quickly these funds were dried up. So we'll have to see. There's no rules yet, and in terms of application, but the rules regarding just the general eligibility and thresholds and whatnot, we're going to go through now. So first and foremost, the thresholds. It's generally 300 or fewer employees. There are certain instances where you can get to 500, but for the most part, it's 300 or fewer. And the similar affiliation rules to the first round of PPP funding, where if you under common management or had different business relationships, and if your employee count went over the 300 level, you may not be available. Although these rules have been waived for the food service and hotel industries, franchises, and certain businesses that receive funding. We can also look to the SBA alternative size standards to see if you can fit through a different way. One of the differences here is that you have to have a 25% decline in gross receipts in any 2020 quarter as compared to a similar 2019 quarter. So that's something they're going to be looking at. How exactly that's documented, we're unsure. Although there is a stipulation in here that says there's simplified procedures for borrowers requesting loans of 150,000 or less. Similar to PPP1 or the first round of funding, you will have a 60-40 payroll cost versus non-payroll cost split, but we're going to see later that there's actually a new categories of non-payroll costs that will qualify. And not only will they qualify for PPP2 or the second draw, they'll qualify for PPP1 as well. So there are some enhancements to PPP1 that we'll discuss too. Also similar to the first round, the caps in terms of the 100,000 of compensation, the owner comp, the retirement benefits, healthcare, all that stuff is essentially going to be the same. So while you will have to do another calculation in terms of your loan amount, most of that information we don't have to go through again. So whereas the first round of funding, the maximum loan amount was 10 million, this PPP2, PPP second draw, has a maximum loan amount of 2 million. And similar to the first round, it's 2.5 times your average monthly payroll costs. However, there's a boon for the struggling hotel, restaurant, and other food service industries in that they can use 3.5 times of their average monthly payroll costs in order to calculate this. And the payroll costs, you'll either do a 1 year prior or a calendar year. So you'll be able to choose whatever is more beneficial for you. And we see some loosened rules here for seasonal employers as well. Now, one thing I had mentioned was that there are some enhancements to PPP1. So this last dash or bullet point under the loan amounts says that the ability for PPP1 borrowers. So this is borrowers who either from the first round who returned all or part of their PPP loan amount or loan, or the loan amounts would increase due to changes in the interim final rules. You're actually going to be able to request additional funding. So nothing to do with PPP2, PPP1, you're going to be able to request additional funding. Now, how do you do that? I don't know, because the SBA has 17 days from the enactment to issue rules. So lenders, borrowers, other participants here, we're going to be paying attention to this too. We have about 2 weeks and we'll see the rules exactly how to do this. Some other information here, fees have been waived for borrowers and lenders, although the SBA will pay lender fees depending upon loan size. And this essentially holds lenders harmless to rely upon documentation that is provided by the borrower. So lenders will not have to do an audit of the information. So they're going to be relying upon the honest and concise documentation and certification that borrowers provide. So in terms of eligibility, the same types of eligible entities, businesses, certain nonprofits, co-ops, veterans organizations, travel businesses, with self-employed individuals and whatnot, agricultural co-ops. However, there is additional eligibility, which are listed here. We won't go through all of it, but in particular, 501c6, which are your business leagues and chambers of commerce and so on. Those are eligible. Publicly traded news organizations, newspapers, public colleges and universities, FCC license holders. So there's a lot more potential eligibility here for borrowers to take advantage of the PPP2. So when we talk about eligibility, we also have to talk about ineligible entities. And so on the next slide, we see here, and this is similar, when we talk about entities listed in this section under the 120.110, those are similar to PPP1. Those are going to be your financial businesses, certain passive businesses, life insurance companies, some government-owned entities. There's even some conflict of interest requirements when there's government-owned businesses. But we also see political and lobbying entities, entities affiliated with China, registrants under the Foreign Agents Registration Act, and something Josh is going to touch upon later, recipients of the Shuttered Venue Operator Grant Program funds, as well as businesses not in operation as of February 15th, 2020. Something to keep in mind, you only can receive one second draw loan. And we want to mention this and beware of the double dipping. As I mentioned before, and Shivani will touch upon this, but the employee retention credit recipients are now eligible PPP1 recipients are also eligible to claim an employee retention credit. However, you're not able to claim the same wages twice. So when you're filling out your PPP loan application, your forgiveness application, you want to make sure that you're not double counting wages. Same holds for the Family First Coronavirus Act credits. These are the credits depending upon if you or a child has been stricken with a COVID-related issue and are unable to work. And also recipients of not-for-profit grants and other funding from the HHS. So you're basically just really need to be careful that you're not claiming the same benefit for the same expenses. And there is leeway there, but it's something you definitely want to work with your provider with, or reach out to us and we can help you. As I was saying, there are additional covered expenses. So additional eligible expenses that for which money can be spent upon. And this is for PPP1 and PPP2. But PPP1 borrowers must keep in mind that if loan forgiveness has already been received, you cannot then go back and say, well, wait a minute, I did spend money on these items. But let's just go through these very quickly. You see covered operations expenditures. So this is software, cloud computing, and other HR and accounting needs. Covered property damage costs, covered supplier costs. So this is a lot of essentially your cost of goods, and especially for restaurants and who have perishable goods. And also we see covered worker protection expenditures. So PPE and adaptive investments to essentially help borrowers comply with COVID-19 related rules. So this is essentially your protective equipment. So a very expanded designation, but again, you do have to make sure you're within the 60-40 payroll cost, non-payroll cost split. Okay, so the covered period. So we initially, when the loans came out, it was an 8-week period. Then it was extended to a 24-week period. It was kind of an either or. Well, these rules have been loosened, and now you can select 8 weeks, 11 weeks, 16 weeks, any 8 to 24 week period after loan origination. So you can cut it off after you spent it all, and that will help you in instances if you've had a salary reduction and other areas. in terms of this loan, and also extends the covered period for all PPP loans through Q1 of next year, so through March 21st of next year. I'm sorry, March 31st, excuse me. Here's something that we've been paying very much attention to: simplified loan forgiveness. We saw back in October with the issuance of Form 3508S that borrowers with loans of $50,000 or less received loosened forgiveness requirements, so that the form that you filed had less requirements in terms of the information you need to provide. Well, now there's going to be even further simplified loan forgiveness in the form of a one-page document, and the SBA, as you see here, has 24 days to issue the simplified form, but it's going to be basically a much easier form for the borrowers to complete and the banks to accept. So you will have to retain your records, and the SBA may take a look at those, but you're not going to have to include those with your one-page loan forgiveness application. So I think somewhere in the neighborhood of about 85% of the first round of PPP1 loan, or the first round of PPP loans, were of 150,000 or less. So this will significantly help borrowers and take some pressure off the banks and the SBA to get you your forgiveness as quickly as possible. Okay, so just some other areas that are covered here before we go to our next polling question. Underserved borrowers and lenders. So certain smaller lending institutions and first and second time draw borrowers with 10 or fewer employees, they set aside some funds specifically for them so that everybody can get access, and it's not just for companies that are requesting larger loans. And this debt relief program extension is pretty interesting too. Under Section 1112 of the CARES Act, and the CARES Act was released 9 months ago, if you can believe it. It seems like a lifetime ago, but it was only 9 months ago. And under that, there was a section 1112, where the SBA paid principal, interest, and fees on certain loans under these basically SBA-related programs. Well, this program will now resume, and either another 6 months of payments will be paid by the SBA. Depending upon if you have a new loan, it'll be capped at $9,000 a month, or borrowers with existing loans will get an additional 3 months. And then after that, underserved borrowers will receive an additional 5 months. So an underserved is still yet to be defined, but we think that from the text is going to be food and beverage, community, items of that nature, just entities that have suffered. But again, we'll see if those rules get clarified a little bit further. And lastly, these forgiveness items, similar to the PPP, it is excluded from gross income, and the expenses that you pay with these are tax deductible. So some definite benefit there. And with that, I believe I'm going to turn it back to Todd for polling question number 2. Todd?
Thank you, Steve. Okay, polling question number 2. Okay, remember, folks, I'm going to give you time to answer, but don't dilly-dally. S2 Solutions is a technology company that was launched in the first quarter of 2020 between Safari Solutions and Saks LLP. You only have 2 choices, true or false, and the poll is now open. True or false? Okay, giving you a little bit more time to vote because not all of you are voting, and you need to answer 3 of the 4 polling questions to get CPE, so I'm gonna give you a little bit more time. True or false? First quarter of 2020, S2 Solutions technology company launched between Safari Solutions and Saks LLP. Okay, 5, 4, 3, 2, 1, closing out the poll. That answer would be true, and 89% of you did get it right. Very excited about this partnership, this joint venture, and you will certainly hear more of it going forward into the future. Okay, now going to turn over this next section to my partner, Josh, to talk further about PPP loan forgiveness. Josh, take
Thanks,
it away.
Todd. Thanks, Todd. Good morning, everybody. So the EIDL Economic Injury Disaster Loan Grant is here to stay. It's back. The $10,000 is excluded from gross income. The expenses are now tax deductible. It extends the period which you can get this grant through December 31st, 2021. You are eligible to receive up to $10,000, similar to remember the past amounts, and it no longer impacts PPP loan forgiveness. So if you have already applied for forgiveness for PPP loan 1 and you have a $10,000 loan outstanding for this grant, then it's certainly time to get in touch with the bank and see how you're able to get that money back or have the loan, if you paid it back already, the opportunity to get the cash back, or if you're sitting with a $10,000 loan, to have that loan removed. So really good. And again, the SBA will issue rules that ensure borrowers are made whole if the EIDL advance was deducted from previously received PPP loan forgiveness. So look, it's not a big amount, but $10,000 is still $10,000 at this point. It establishes a targeted EIDL advance, like we said, up to $10,000. If you remember all the way back to April, initially everybody got $10,000, and then because money was running out of the program, they limited it to number of employees. So if you had 1 employee, you received $1,000. If you had 5 employees, $5,000. There's also additional targeted funding for entities in low-income communities. And there's some additional flexibility here. So it softens the verification process and extends the approval and disbursement period from 3 days to 21 days. We do believe that this is a one-shot deal. So if you did receive $10,000 on the first go-round, you will not be eligible to receive it this time. But like I said, that is one of the areas where we're waiting for some additional guidance. There's also no mention in the Act of an extension to the EIDL loan program. So if you remember, many folks received $150,000 through the Economic Injury Disaster Loan Program. That is currently set to expire December 31st, 2020. So if you are in need of cash with, little to no other possibilities at this point, you still have 2 days to get that application, and I do believe there still is money in that program, and you do apply for that through the SBA.gov website. That is not a loan that goes through the banks. Okay, so grants for shuttered venue operators. So it authorizes $15 billion for the SBA to make grants to eligible live venue operators or promoters, theatrical producers, live performing arts organization operators, museum operators, motion picture theater operators, or talent representatives who are able to demonstrate a 25% reduction in revenue. There's also a set aside of $2 billion for eligible entities that employ not more than 50 full-time employees, and any amounts from this set aside remaining after 60 days from the date of implementation of the program will become available to all eligible applicants under this section. So if you're less than 50 full-time employees, you kind of get the first bite at the apple for that $2 billion. The SBA can make an additional grant. They can make an initial grant of $10 million to an eligible person or entity, and then a supplemental grant that is equal to 50% of the initial grant. In the initial 14-day period of implementation of the program, grants shall only be awarded to eligible entities that have faced 90% or greater revenue loss. In the 14-day period following the initial 14-day period, grants shall only be awarded to eligible entities that have faced 70% or greater revenue loss. And then once those 2 periods go, again, it's eligible to the rest of the shuttered venue operators. Remember, you're only eligible for this funding if you were in operation as of February 29th, 2020. As Steve mentioned at the beginning, you did not receive any PPP funding, and the business is open or intends to reopen as of the date of the grant. And as you can imagine, there will be certainly SBA oversight similar to the PPP program. So as I said before, the initial grant, the entities in operation as of January 1st, 2019, you can get up to $10 million. There's a threshold there, so lesser of 45% of 2019 gross revenue earned, or 10 million. Entities that began operation after January 1st, it's calculated as 6 times the average monthly gross revenue earned for each full 2019 month, or again, capped at 10 million. As I mentioned before, you may be eligible for a supplemental grant equal to 50% of the initial grant and the implementation period. So for the first 14 days, again, just to reiterate, if you had a 90% or greater revenue loss, the 14 days following is only entities eligible with 70% or greater revenue loss, and then everybody else. Eligible costs under the program are similar to the PPP loan, and these are excluded from gross income, and the expenses are tax deductible. So I've heard from a few of you out there. These are the rules as we state today, and as Steve mentioned before, the SBA does have an initial 24 days to put parameters around the program, so stay tuned. Just some other provisions and benefits in the Act. There's an emphasis on education. There's $81.9 billion set aside for the Education Stabilization Fund. You can see the breakdown below. Additional $69 billion went into vaccines, testing, and health providers. $45 billion allocated to transportation. $25 billion earmarked for rental assistance. And in terms of other provisions and benefits, supplemental nutrition assistance program, money into childcare, U.S. Postal Service, and broadband access, so internet for those folks who have who need it. And now I'm going to turn it over to Shivani to discuss some of the tax benefits and tax extenders.
Good morning, everybody. Hope all of you are staying safe. I'm going to talk about the tax provisions of the Consolidated Appropriations Act. I'm going to refer it as CAA going forward. CAA has used CARES Act as a base, and a lot of provisions of the CARES Act have actually been extended, maybe modified in this act. So starting off with the most talked about provision is the recovery rebate for individuals. Under the CARES Act, as everybody knows, a single individual got $1,200. Under CAA, the rebate is now $600 for a single and $1,200 if you're filing a married filing joint return. The rebate which they are giving for a qualifying child has also increased from $500 to $600 per qualifying child. There is talk about, or I should say that an act was passed last night in the House. It's called the Cash Act. It was passed 275 to 134, which could potentially up this rebate for a single individual to about $2,000. The cost of it would be around $464 billion. So I'm not really sure if it would pass the Senate in its current form. So going back to what a qualifying child is, the qualifying child could be a stepchild, an adopted child, a foster child, or a sibling, brother, sister, stepbrother, or a stepsister. The age should be under 17. They must be U.S. citizens, nationals, or residents. They must have lived with the taxpayer for more than half of the year. They cannot provide more than half of their support, and they must be claimed as a dependent. Now, the Cash Act, which was passed in the House yesterday, actually expanded, who could be claimed, and they have actually included some adult dependents that could be your college student, your disabled, any disabled adult, or any elderly relative who you are caring for could also qualify now for this additional $2,000 if the Cash Act passes. The advance credit is subject to phase outs. The phase outs limits here are much lower than what we had under CARES Act. So under CAA, your credit will start phasing out once you hit the AGI of $150,000 for a joint filer, $112,500 for head of household, and about $75,000 for all other taxpayers. Certain recipients are not eligible to get these rebates. Non-resident aliens are one of them, states or trust, an individual who qualifies as a dependent of other, and individuals without a social security number. Now, CAA has actually expanded, or they've made one change with respect to non-resident aliens. If you are a joint filer and one of the married person is a non-resident alien, you are now eligible to get this rebate payments. So earlier it was anticipated that the checks would go out, in the last week of December, but because the president did not sign this act into law, the payments could go out as early as January, but the code provides that it should be made no later than September 30th, 2021. All these rebates are calculated based on your AGI for 2019. Remember, it's an advance credit against your 2020 return, so it will be recomputed once the 2020 return is filed and based on the 2020 AGI. So if your 2020 AGI is higher than the 2019 AGI, and let's say you got more money than you should have gotten under these calculations, you don't have to repay the money which you got. But if your AGI in 2020 is lower, maybe you get more money or more rebate out of this, then you would get it on your tax return, on the 2020 tax return when you file it, and it will be a refundable credit. Going on to the other provisions of CAA, unreimbursed medical expenses are generally subject to limitations, itemized deduction limitation, whereby you can only claim it to a certain percentage of your AGI. That has probably isolated between 7.5 or 10%. So CARES Act actually capped it at 7.5 of the AGI. Any expenses in excess of the 7.5 of your AGI could be claimed as a deduction. CAA makes this provision permanent beginning December 31st, 2020. Next slide, please. Mortgage indebtedness also was forgiven under CARES Act for years beginning December or up to years December 31st, 2020. The amount that could be excluded was subject to certain limits. For a married filing couple, it was $2 million and about $1 million if you were filing a married filing separate return. CAA has made two changes to it. One is that now this exclusion is extended to December 31st, 2025, but the maximum acquisition debt limit has been reduced significantly to $750,000 for married filing joint and $375,000 for married filing separate. The CARES Act also excluded around $5,250 of student loan payments that were made by the employer between March 27, 2020 to December 31st, 2020 from the employee's gross income. CAA now extends this exclusion to 2025. CARES Act created a special above-the-line deduction for non-itemizing taxpayer of up to $300. And if you were a married couple, you could claim $600 above the line deduction for any charitable contribution you made in 2020. CAA actually extends it for 2 years now, so you can claim it for 2020 and 2021. However, the penalty, which is attributable to any overstated cash contributions for non-itemizers, has now increased from 20% under the CARES Act to 50% under CAA. In addition to that, if you were itemizing, you can deduct qualified charitable contribution up to 100% of your AGI. The definition of qualified charitable contribution is it has to be made in the form of cash and has to be made to public charities. That means that your donor advisor funds or private foundations would not qualify for this 100% deduction. CAA also enhanced the food inventory deduction, which was in the past 15% to 25% of your taxable income. So that was there for tax years 2020. CAA now allows you to take it for 2020 to 2021. In addition, businesses are also permitted to deduct qualified contributions, which we just defined on the prior slide, of up to 25% of their taxable income. Now, just remember that your non-qualified contributions come first and your qualified contributions come later. So if you've exhausted the limits based on your non-qualified contribution, you will have very little AGI left to use for your qualified contributions. This is a small benefit given to eligible educators, teachers, and instructors of kindergarten through grade 12. They were historically allowed $250 as an above the line deduction for any expenses they incurred in their trade or business. Now these expenses, effective after March 12, 2020, includes PPE, disinfectants, or other supplies they may use for the prevention of the spread of COVID-19. There have been some changes to the carryover rule of the FSA. Generally, the carryover rule is any amount of health FSA as of the plan year end can be carried over to the extent of $550. The carryover period under CAA has been extended or expanded for 2020 and 2021. Employers would now be able to extend the grace period of the plan ending in 2020 and 2021 to 12 months after the end of such plan year for any unused benefits and contributions or dependent care flexible spending arrangements. Another significant change is that if an employee ceases to participate in the plan during the year, calendar year 2020 or 2021, they can continue to receive reimbursements from these unused benefits or contributions through the end of the plan year, including any grace period. I think this is a big one, and it was talked about a lot, like the rebate. And the 100% deduction on meals was, I think, probably eliminated about 30 years ago, but they have brought it back for 2021 and 2022 just to help our hurting restaurant industry. So previous to this change, your deduction for food and beverages associated with operating a trade or business was limited to 50%. For periods January 1, 2021 to December 31st, 2022, any expenses paid to a restaurant for food or beverage would now be 100% deductible. Depreciation of residential rental property. CARES Act actually brought Section 163J into place, whereby your business interest deduction was limited. If you own a real property, trade, or business, you could actually elect out of this business interest deduction limitation. But if you elected out, you had to now depreciate your property under a different depreciation method, which was alternative depreciation system, or we call it as ADS. TCJ also changed the recovery period of the rental property, residential rental property, from 40 years to 30 years if the property was placed into service after December 31st, 2017. What does CAA do now? So CAA now assigns a 30-year ADS life to residential properties, even though it was placed in service before January 1, 2018, if the property is held by an electing real property trade or business, but wasn't subject to ADS before. Work opportunity credit, this is a credit that is available if the employer hires about the 7 categories of people. The credit could range from $2,400 to almost $9,000, depending on which category of individuals you hire. It could be qualified veterans, qualified ex-felons, long-term unemployed individuals, individuals from some designated community residents. So this credit was set to expire on December 31st, 2020. CAA now extends this credit through 2025. This was a provision which the president, signed into memorandum sometime in end of August, whereby the employers were allowed to defer their employees' share of payroll taxes for the period beginning September 1, 2020 to December 31st, 2020. Payments were required to be made after December 31st, that is from January 1, 2021 to April 30th, 2021 gradually. CA now extends this payback period to December 31st, 2021. So now the employers actually have a whole year from January 1, 2021 to December 31st, 2021 to make these payments, which they did not make and which were withheld before. Now, if you don't make the payments by January 1st, 2022, interest and penalties will start to accrue on these deferred taxes. There was another provision that was signed into law under the CARES Act, which was basically that certain eligible employers could elect to take general business credit on the wages they paid to qualified employees with respect to their family and medical leave. The credit was equal to 12.5% of eligible wages if the rate at which you paid the wages was 50%, and it would increase 0.25 percentage points, and the max you could go up to was up to 25% for each percentage point that the rate exceeded 50% of the wages. The maximum amount of family and medical leave that could be taken into account for any qualifying employee was 12 weeks. CAA now extends this credit through 2025, applying to wages paid during the years beginning after December 31st, 2020. So I think I'm going to go in much detail with the employee retention credit. There have been some significant changes, and we'll go over some of the examples just to clarify that. I know Stephen mentioned the interplay between PPP and employee retention credit, that now, taxpayers who have applied for PPP can apply for employee retention credit. We are still waiting for guidance from IRS on the mechanics of how it's going to work and how the calculations are going to be done. But I think we'll talk about, what we know so far. So under the CARES Act, employers were allowed a payroll tax credit of an amount equal to 50% of qualified wages for each quarter with respect to each employee. We'll go into the definitions of qualified employer and qualified wages in a little bit. What does CAA do? CAA now increases that credit amount to 70% of your qualified wages for each quarter with respect to each employee. Now keep in mind that the 70% increase is not retroactive. So you would be calculating the credit at 50% from about March to December of 2020, and then from January 1, 2021 to June 30th, 2021, you will calculate that at 70%. So it's an increase in 2021 and it's not retroactive. The next big change is that the maximum wages under the CARES Act, which is in place till December 31st, 2020, you could take was $10,000 per employee per year. So the maximum you could take on any employee was $10,000 of qualified wages. Under CAA, that $10,000 had now been expanded to any calendar quarter per employee. So technically, you have 2 quarters till the provisions of CAA expire on June 30th, 2021. So the maximum wages you could have for any employee could be $20,000 in this case. The maximum credit, just to do the calculation math, we said it was 50% under the CARES Act, and the maximum you could take was $10,000 per employee. So the maximum credit you could have gotten in 2020 for any employee was $5,000. Whereas the maximum credit which you can get under CAA is $7,000 per quarter, which is basically $10,000, the max cap times 70%. So if this employee was qualified for both the quarters, your credit could be $14,000 for the whole period of January 1 to June 30th, 2021. The credit period under the CARES Act is March 13, 2020 to December 31st, 2020. As I said before, that this credit has now been extended to June 30th, 2021. As Steve mentioned and I had discussed before, under CARES Act, if you had applied for PPP, you would not be eligible for employer retention credit. But now, retroactively, that is going back to March 13, 2020, wages that are not forgiven via a PPP loan can now be used as qualified wages. Next slide, please. So what is qualified wages for employers? Qualified wages has different definition. Under CARES Act, if you were 100 or less employees, all your wages would qualify irrespective if the employees worked or not worked. And if you had more than 100 employees, only the wages that were paid to employees who did not work qualified. These limits have been increased by CAA from 100 to 500 in both the cases. What are eligible employees? There's a big change here as well. The first condition has remained the same. You have to meet either one of the conditions. Either your operations should have been fully, partially suspended as a result of the government order limiting commerce, trade, or group meetings. That's same under the CARES Act or CAA. The next requirement has changed drastically. Earlier, at least 50% decline in gross receipts when comparing quarters between 2019 and 2020 had to occur for you to be eligible for this credit. Now that decline in gross receipt limitation is 20%. So, that's a significant change. And when you're doing these calculations for 2021, you're actually comparing your 2019 quarter to your 2021 quarter, because that would make sense. Your 2019 quarter probably had higher receipts, and your 2021 is probably going to have lower receipts, so it will give you a bigger spread to meet the requirements. Now, if a business did not exist in 2019, then you can substitute 2019 by 2020. One other significant change under CAA is that taxpayers can elect to satisfy the gross receipts test by looking at a calendar quarter immediately preceding the quarter which you're comparing to. And I think this will be clear with an example I give you in the next few slides. So just to take an example, if this was 2020, you had to meet the 50% threshold. That means your receipts should have gone down by 50%. So here in this example, the 2019 receipts are 210,000. The 2020 receipts are 100,000. So you have a decline of 48%. So the employer would qualify for this first quarter. The second quarter, you were at 230, and your 2020 receipts were 190, and you were at 83%. So the old rule said that the quarter in which you exceed 80% also qualifies. So here, the employer would be entitled to a retention credit with respect to your first quarter and your second quarter, and not the third quarter. So we were talking about, an election which the employer can make to look at the prior preceding quarter. So I think this example clarifies it a little bit. So in your first quarter, when I compared 2020 receipts and 2019 receipts, we had a 48% decline, 53% decline in the second quarter. The third quarter had 92% decline, and the fourth quarter had 66% decline. So when I'm looking at 2021, I'm supposed to look at my first quarter receipts, which are 180,000, and I'm supposed to look at 2019 receipts, which are at 210,000. So if I take the percentage, I'm still at 85% of my receipts of 2019. So technically, I do not qualify to take the employer retention credit because there's not more than 20% decline. What I can do is I can look at my prior quarter in the prior year. So I can look at 2020 fourth quarter, I was at 200,000, and I can compare it to the 2019 quarter where my receipts were $300,000, and there the decline was close to 33% because I was only at 66%. So if I make the election to actually look at my fourth quarter, now my decline is more than 20%, and I will be eligible for the employer retention credit in the first quarter of 2021. Just a real quick computation on, just to show you how the benefit has changed between 2020 and 2021. So let's assume that ABC is an eligible employer. Maybe the receipts they're meeting the receipts threshold, or they were totally shut down. They have 4 employees, A, B, C, and D. and these are their quarterly wages. So when I'm calculating quarter one, remember this is 2020. So the max you can take for any employee is $10,000 overall for the whole year. So when I'm calculating quarter one, employee A 8,000, I can take 100% of that. Employee B is at 12,000, but remember our max amount can only be 10,000. So that's what I'm taking for employee B in quarter two. Employee C and D, I can take entire wages. So for quarter two, my total eligible wages are $24,000. Coming to quarter three, employee A was paid $7,000, but remember the max we can take is $10,000. We've already utilized $8,000 in quarter two, so we can take additional $2,000 in quarter three. Employee B had already maxed out, so we can't take any more, and C and D qualify for 100% of their wages. For the fourth quarter, we have maxed out for employee A, we have maxed out for employee B, employee C and D, we can still use their wages. So in total for 2020, I have $36,000 of wages, and the credit percentage is 50 there. So what I can get as employee retention credit is $18,000. Employee retention credit computation, how does it change in 2021? Remember now it's $10,000 per quarter. So using some similar numbers, in quarter A, I have $8,000 for quarter one. I have $8,000 for employee A. I have $10,000 max for employee B. C and D, I can use their entire wages, $4,000 and $6,000. So it takes up to $28,000. For quarter two, I can utilize $7,000 for employee A because now I have a $10,000 limit per quarter. For employee B, even though he was paid $14,000, the maximum amount I can take is $10,000. And employee C and D, I can take 100% of their wages because they are under $10,000. Here the total is $55,000. The credit limit has gone up to 70%, so the maximum credit which I can take is $38,500. This is a pretty quick slide that, the work opportunity credit, and, if you're taking any other credits, you can have double dip it with the employee retention credit. I think these slides will also go pretty fast. The employer credit for sick pay and family leave has also changed. The CARES Act provided that these provisions were from April 1, 2020 to December 31st, 2020. CAA now extends these provisions to March 31st, 2021. The definitions of who qualified have not really changed. It's $511 if certain conditions are met, like condition 1, 2, and 3, which I've explained in the next two slides, which are basically, if you are somehow impacted personally by COVID-19, and the maximum amount you can take for these credits is 10 days, and it's $200 if somebody else you're caring for has been impacted by it. You can claim these credits on your payroll tax returns. The next two slides just give you the conditions, so we can just skip through them. As I said, the family leave credit for the employers has also been extended by the CAA to March 31st, 2021. Here, the maximum amount you can take is $200 per day, up to $10,000. And this is also for employers with less than 500 employees. Here, the condition is when an employee cannot work or telework because they are caring for a son or daughter who is under the age of 18 because the children's school or place of care has closed or they are unable to provide any childcare services. So with that, I'm going to wrap it up. Wishing all of you a happy, healthy new year. Back to you, Todd.
Thank you, Shivani. Okay, poll question number 3, folks. In order to get CPE credit for this webinar, you must listen to the full 50 minutes, complete 3 of the 4 polling questions, complete and send in the evaluation, all of the above. All right, folks, looking forward to you answering these questions. So start voting. And this is poll question number 3. We have one more after this. We have exceeded the 50 minutes, so you got that part. And if you answered the 2 before, this is your 3rd one. And I'm going to do a countdown. 5, 4, 3, 2, 1. Answer. All right, most of you got it right. All of the above. All right, I'm going to wrap up this next section rather quickly. Loan forgiveness and application timing. Okay, folks, I'm not going to go through all this specifically because it's going to be in the webinar handouts. You're going to get the presentation, but just a few things to know. It really does depend upon your circumstances. The rules did change under the CAA Act, and there are certain things that you need to consider before applying, but know this too, and you can go to the next slide. Know this too, that there are banks that right now, if you were to try to apply, you will not be able to apply. I know just recently one of our clients went on the portal of a pretty large bank and they said they are not accepting any applications due to the legislation that was passed on December 21st. So do be thoughtful as to when you apply. Consider the fact that under the changed rules, there are additional non-payroll costs that can be applied. So the answer to your question, if you're asking, can you apply for PPP2 after not, if you haven't received forgiveness for PPP1, we believe the answer to that is yes, but it's going to depend. Next slide. Okay, next slide. And basically, we're going to take this to the last polling question. But before we do, for that polling question, just know you'll see also that we still have the PPP tool that we're offering to our clients and anyone else who would like to work with us. And if you want some additional information, feel free to reach out to us. Okay, this is an important polling question. In 2021, Sachs LLP will be celebrating what anniversary? Get ready to make your selection. Is it the 25th anniversary, the 65th anniversary, the 100th anniversary, or the 55th anniversary? So it's 25, 65, 100, or 55. Which anniversary is an important anniversary that we'll be doing in 2021? Okay, I can see you folks are submitting your answers. Keep going, because I want you to be able to get the CP. Remember, you have to get 3 of the 4 polling questions out of the way. Okay, I'm going to count down. 5, 4, 3, 2, 1. All right, so thank you for not saying it's going to be the 100th, but if you guessed the 65th, which most of you did, that is the correct anniversary that's coming up in 2021. So final thoughts on 2020. I would like to spend more time telling you all the things that I think we feel, but I think that the expression, it's a long, strange trip that we've been, is a good expression by the Grateful Dead. I don't know what 2021 is going to hold, but there's been a lot of tremendously difficult things, but a lot of good things too that have come out of this past year. I'm happy to say that we'll be continuing on these webinars going forward. And probably you'll see us within the first 2 weeks of January after the SBA gives us some more guidance, coming out with some more information. I know you get our e-blasts. And guys, do you have anything you want to add in our closing remarks? Steve, Josh, Devani?
No, I think that you put it well. Just hope everyone be safe and looking forward to having a better 2021 than 2020.
Agreed.
Okay.
Agreed.
Thanks, guys. So wishing you a happy new year. And next webinar, we will see you in 2021. Be safe and remember, keep on smiling. Have a great day.